So there was this big mentality and the herd all started moving toward, oh yeah, ESG is the future. ESG is the future.
Yep.
And I sat here and I'm like, if ESG is the future, then the S&P 500 is going to gravitate to ESG anyway.
Right.
So therefore, why would I pay BlackRock another 15 basis points, 0.15%, which equated to over $52 million in additional revenue off of one fund?
Yep.
When the S&P is going to have the exact same ESG ranking as these other funds.
Yep.
And that's exactly what happened. Welcome to the Wiser Retirement Podcast. Are you curious about how emotional investing can impact your portfolio? I'm Casey Smith. I'm joined today with Senior Financial Planning Associate William Metcalf. Each week, we bring you practical advice on retirement, investing, and planning for your financial future. Don't forget to subscribe to the podcast wherever you're listening. Let's get started. Hey, William.
Hey, good morning. How's it going?
Man, doing good. Going good. You've, what's that smell? Oh, that's a newly minted certified financial planner.
That's right.
Congratulations.
A lot of work, a lot of time.
Is it kind of like a new car smell? Just
no,
a lot harder
I feel
to
exactly
get?
the same.
Oh, you feel
my email signature is different. That's it. So.
That's it.
Not really. No, it's a big accomplishment.
Are you having Abby at home call you William CFP?
No, not that vain. No, it's great to have it out of the way. I took the test in November. And that was the hard part. The experience was just time. And that's what kicked in this past weekend. And
he's got the 3 years of experience to use the CFP designation. So congratulations, man. I know that was hard work, and it's one of our requirements to be promoted here is to have the CFP. Yep. So you are on your way on the fast lane. I did something cool this weekend.
Yeah, you did.
I went to my first Formula One race in Miami.
Yeah.
I knew really not much about it. I intended to do the research and maybe watch an old race to figure out what's happening prior, but Wiser has me pretty busy. So I did none of that. My 13-year-old asked to go a while ago, and he's like, Dad, can we go to this? Can we go to this? And his brother and sister are very expensive, and he never really asked for that much, other than, occasional baseball bat for baseball. But I was like, you know what? We need to have some time with just you and me. Let's go do it. Yeah. And so we flew down to Miami, and man, it's pretty cool. Yeah. It's pretty cool.
Did he have a team that he follows or that he prefers?
He did the Red Bull team. Okay. And so I just bought the Red Bull gear too, because I know Red Bull from aviation. Right. When I was down at Sun and Fun this year, the Red Bull team, dropped a Cessna 182 straight down to the ground, and fireworks were coming out the wings, and the guys jumped out in their little squirrel parachutes, and they had fireworks shooting off of them. I mean, it was crazy. So I'm like, well, if the Red Bull drivers are anything like the guys who jump out of stuff, I'm going with them. Yeah. And they did okay. McLaren, is that, am I pronouncing that right? Yeah. They were first and second. Okay. The race was a little hot and heavy for the first few laps. And after that, the number one car lapped the guy in last place. Yeah.
I think that happens pretty regularly. I haven't watched F1 consistently in a while, but right. Yeah.
It was like, if I play video games with my kids, I feel like that I'm the last guy. It was like a pink Visa car. I don't know exactly who.
I can't even tell you.
Who drives it, but I was like, that guy is, I don't know. I mean, I wouldn't say he's bad. I mean, he's there at that level, but he pitted first for some reason. Like, he didn't even go to the start line. Oh. So something was wrong with his car. I guess, from the beginning.
The car is what really is the differentiator between those, because there's the different teams, all their cars are different. They build them. It's a whole 2-year, 3-year process for them to actually spec out the car, basically. So it's like a pretty intensive process. I was really concerned about being hot, having extremely long lines for restrooms and food and all that stuff. So I did go one notch up. We did this Turn 18 hospitality suite. So the hospitality was actually inside the Dolphins practice facility. So you couldn't see the race, but people were come and go in their helicopters. Oh, yeah. Which was kind of weird. Do you have the Wiser helicopter there?
Did not have the Wiser helicopter there. No. And then, and then you go sit in the grandstands with everybody else, which I assume had hospitality access also. Not really sure on that. But the guy sitting next to me for each, because there's races, different races on Saturday and Sunday. So there's a Porsche race. There is a women's race that have their own, what look like an F1 car. a little smaller version of that.
Okay.
And then there was a sprint race, which is the F1, but shorter, I think only 18 laps.
Yeah.
19 laps.
Yeah.
And then there's a big race on Sunday. So the person sitting next to me is different every time. So I'm not sure what was going on there, but the last guy sitting next to me, he had a daughter dating one of the drivers.
Okay.
Which I thought was interesting. So I got a lot of inside information on what was happening.
Yeah.
But here's where I knew I was out of place right away. He goes, "You have to be careful here though." And he's looking at my wrist. He goes, "Well, I guess you just have a normal watch. It's okay." He goes, but last year I had a $400,000 watch stolen off my wrist here. And I was like,
yeah.
Of course, my 13-year-old, they always blurt out what they're thinking, right?
Yeah.
He goes, $400,000 for a watch?
Yeah.
And I'm just trying to sit there and I'm like, that's normal.
Yeah.
I had to use ChatGPT later to say, what watch costs $400,000?
Yeah.
And they gave me a list of 5 different ones. Had no idea people could spend that much money on a watch. If it had diamonds or something in it, that's one thing, I guess. But yeah, that was insane.
There's definitely diminishing
even
returns
diamonds
at some
wouldn't
point.
cost $400,000, I don't think.
You probably have a lot of diamonds. Yeah.
Right.
Yeah. Yeah.
So it's a very more affluent crowd, very international crowd.
Yeah.
Just because, there's only 3 races here in the States.
Right.
But it was interesting. I would encourage everybody to go do something new and learn something.
Yeah.
We've kind of done that in the past. We've been to a couple of SpaceX launches when they launched the astronauts to the space station. Yeah. That was really cool to go and kind of learn about what was happening there.
Yeah, that's cool.
Again, that was one of my son's requests, my 13-year-old's. But it's always good to get out there and learn something new and meet different people.
Yeah, for sure.
But yeah, if you want any tips, DM me. Oh, I will tell you one quick thing. So, I'm not big on social media. I post things occasionally, but it's not like it's just like runs my life.
Right.
So lately I've started spending more time on X. You can, my X handle is Bullish Pilot. So bullish, but it's BULL, then the number 1 for the I, and then SH Pilot. That's how I could get finance and aviation kind of wrapped into one.
Yeah.
But the parade for the Formula 1 was Lego cars. So they built these humongous Lego cars. I think there were 400,000 pieces and 22,000 man hours.
Oh, wow.
To build these things.
That's cool.
So then they gave them to each team and they drove the track going kind of slow. There's a parade, around the track. And then right in front of us, one of the drivers got kind of aggressive with each other and they collided and these Lego pieces started going everywhere.
Oh, wow.
And they got stuck. And so I just happened to be videoing it.
Yeah.
And so I posted it on X, which immediately got like 10,000 views.
Oh, wow. Casey's viral.
Yeah. And like 120 likes. And I'm like, what is going on? I post finance stuff all the time and never get this kind of reaction.
Random.
But yeah, it was some random thing. And then Sports Bible had me fill out a disclosure, giving them permission to use the video. So it was my 15 minutes of fame.
There you go. That's cool.
Anyway. All right. So let's get started into today's podcast on fear, greed, and the markets. I think this is something that I put on the docket probably about 6 months ago, just because I think it's so important that we understand how human nature works against our ability to be successful in investing. And William, you have put in the man hours to go through and research each of these. So I do not want to steal your thunder. Let's get started. Let's talk about emotional investing. So when we just define this and why it matters.
Sure. So emotional investing is kind of what it sounds like. Essentially, it's just allowing your emotions or your, non-qualitative or data-driven thoughts drive your investing habits. And it's typically, based on something recent. We'll get into kind of the different behavioral finance terms for different biases and things like that. But as a broad level, it's basically just letting your emotions drive your investing instead of your plan or your investment strategy.
So give me some examples of that.
Yeah. So the one that I picked out just being, on the younger side is like if you were to buy GameStop back in 2021, when that was a big hype thing, especially people of my generation. That was like, I knew people that did that and they bought like at the high. And I looked at GameStop stock yesterday, and it still hasn't even come close to the high in 2021 because it wasn't a real, financially driven
it almost
investment.
Became like a meme stock. It was just being driven up by social media mostly.
Yes. Yeah, I think it was trading at like $1 to a share at the time, and then it got shot up, like over 100 times in value.
Hertz was another one.
Yeah,
as well, because it was
and AMC back then too.
Yeah. Hertz was literally in bankruptcy. The stock was going to be devalued to zero.
Yeah,
they started bidding it up for some reason.
So just getting swept up in the whatever the current topic is in the media or the podcast you're listening to, and making decisions based on that instead of kind of a strategy that you've put in place for a long-term investment.
I feel like meme coins, crypto.
Yeah,
not all crypto, but the ones that don't have purpose.
Right. Dogecoin. And
right.
Yeah.
Those fall in those lines.
Yeah, for sure.
People don't know why they're doing it, but they're just doing it, and it's supposed to be going up in value. Right.
Yeah. I mean, another one obviously would be like selling to cash during a market decline. And that's one that we, I don't think we would see very often, but when people get a little bit antsy about the market, then that's something that it becomes a topic of discussion. We see it online. So, you have a long-term investment strategy, and you're letting, the market or the news cycle essentially drive your investment strategy at that point.
If you think about something long enough, human nature is that it'll be true in your brain.
Yeah.
And this is, even though you're thinking about it incorrectly.
Yeah.
Or you don't have any facts on it whatsoever.
Right.
You see this when some of the comedians go to the streets with their cameras and their microphones, and they ask people questions about the economy or something that's real.
Yeah.
And the answers that you hear, like, there's nothing factual about that whatsoever.
No.
Yeah.
Yeah.
I have it's on my wife's side of the family. I like to point that out. But I had a family member one time ask me, when I was an airline pilot, how often did we do the chemtrails?
Yeah. Yeah.
And I just sat there, and I was like, what? And he's like, the chemtrails, like in his brain, he convinced himself that was a real thing, that was something that was happening.
Yeah.
I said, there's no such thing as chemtrails.
Yeah.
And he's like, no, it's real. And I said, well, let me tell you the science behind how this works, and why that happens. So let me explain to you the science. And then he was like, he had no idea.
Yeah.
Just no idea.
Yeah. So you can't let the last thing you hear guide your investment strategy. That's not a good way to, manage your finances, for sure.
So what are some common emotional triggers that cause us to make irrational decisions? Emotional decisions?
Yeah. I think the most common is probably fear. I think, in times of market uncertainty, that's probably the one that comes to mind first. Just because, especially if you're already retired, somebody younger, volatility doesn't bother them as much, but somebody that's retired or close to retirement, volatility is scary because it's your entire nest egg that you've saved for retirement, and, it's going up and down, and sometimes it's up and down a lot. So that's one emotional trigger. I think greed is another one. And, I think we typically see that during different booms. And again, I think it goes back to the media cycle. It's just what people are talking about. And I remember like 2022, I feel like was like crypto mania. Like everybody was talking about crypto. I mean, it's a little more mainstream now with the ETF launches and stuff like that. But back then I remember a lot of people, again, buying at the high,
Yeah, before crypto was commodities. So like coming out of the financial crisis, we had really high commodity prices.
Yeah.
And I have what they call the barber test. If I go to my barber and the barber is asking me about how to buy oil or how to buy commodities.
Yes.
Then that's like, okay, we've reached an all-time high when your barber's talking about it. And exactly the top side of crypto is the exact same thing.
Yeah.
Everybody in the barbershop was talking about how do I get into crypto?
Yeah.
And there wasn't a Coinbase or anything like that back then.
Yeah.
So
yeah, I knew people that lost wallets and all that stuff too. So it's like, you got to actually know what you're doing too, if you're going to do something like that. But yeah, greed is one, fear of missing out's a big component to that. And I think that's part of what drove the crypto craze that we were talking about. And, people, a lot of the time, by the time that registers, it's already at the top or close to the top. Right. So, that's one trigger. Regret is one, past losses, or, one that I hear people say a lot, is like, oh man, if I had bought Google stock back in, 1995, like I would be a millionaire. And it's like, okay, but you didn't know that at the time.
Right.
And, but people have that, we'll talk about it later, but that's like hindsight bias, kind of judging, right now against what you didn't know in the past, but it's kind of assuming you should have known, or that you did know and just didn't act. So that's one as well. But yeah, overconfidence and confirmation bias are, I wouldn't say those are triggers, but that can be kind of a component of regret, I would say, because if you already know something, it's easy to go back and look at the past and say, I should have known that. I should have made that investment. I should have bought Bitcoin at $1 or whatever, So I think those are things that people, that trigger people into these decisions.
Which bias is it when you don't feel like you have any biases?
That's a good question.
We have a lot more to cover, but a lot of times I feel like I talk about this and talk to clients about this, and everyone's like, oh no, that's not me. It's like, I was at a conference one time. It's kind of crude, but this guy goes, how many of you in here wash your hands after you go to the bathroom? Of course, everybody in the whole room raises their hands.
Yeah.
He goes, I stood at the Atlanta airport for an hour he goes, don't get weirded out. I was just standing there at the sinks and I was clocking, and he goes, only about 30% of you actually washed your hands.
Yeah. I believe that.
And then he asked again, he said, how many of you consider yourself to be good drivers? And there were a few hands that were down, but most of the hands were up. And he goes, according to the latest insurance studies, 40% of you are lying right now.
Yeah. It's probably more than that. At least in Atlanta.
At least in Atlanta, right. So yeah, we have biases that we don't even know we have biases.
Yeah. No, that's very true. So I think, that is something to consider when you're thinking about this, because, if you're just doing something by yourself, you don't have somebody to bounce things off of. And I think that that's an important component of forming a good strategy is having multiple people involved that you can, that have their own biases and their own opinions and maybe different data that you're not familiar with. So I think that's very important, for forming a long-term financial strategy.
So behavioral finance is, something that hasn't been around forever. I think probably 15 years ago, we started really seeing it in academia, kind of pop up. It could be a little longer than that. Time's flying a little fast for me right now.
It's definitely been around, but people started talking about it.
Yeah, right? But if people started talking about it, but I just mean I'm saying it in curriculum,
right?
There's even minors in behavioral finance, right?
Yes.
At this point,
yes.
But I found this very interesting. I actually audited a few classes, Robert Schiller's classes. He had a behavioral finance 101 class that he would teach, or 301, something like that. And it used to be on Apple. You could download class notes and watch the lectures.
Okay.
And so I watched his entire behavioral finance series. It was very good, very eye opening as to why we do things. So let's talk about this first one, loss aversion.
Yeah. So that's, that one's interesting. Basically, loss aversion is trying to quantify or explain why gains feel so much better than losses, and people will avoid risk for a potential gain in order to avoid losses. So basically, because losses hurt more than gains, people, this is like, I'll just stick it in CDs,
Yeah.
Because I know that there's not going to be loss, even though I know that inflation is going to really eat away at that. And that's a risk in and of itself, right? Mm-hmm. People really do fear loss more than they enjoy gain.
So that way we know that we're supposed to ride out the market, but we just can't do it because we don't like this feel that we're losing.
Right.
And especially in our country now, because if we feel like we're losers, we go to a psychologist, they give us pills, and we take these pills and we feel like we're winners.
Right. Yeah.
And we give participation trophies out to everybody, even the person in last place, because we're winners.
Yeah.
So you don't ever want to feel like you're losing. And that's where education has to come in. We have to be able to educate our clients as to why they have to go through this process and why, it's not really losing, but it's also how bad advisors sell annuities.
Yes.
And whole life insurance is the only means for saving for retirement.
Right. Yeah.
Right. It's because they focus on people's loss aversion. They want to avoid losing money. We had a prospect one time. Actually, she's a client, been here for 10 plus years, but she was there. Someone in her essential class is trying to get her to buy a $3 million annuity, basically put all her money into the annuity. Yeah. And she circled every single loss, not since inception in her portfolio, but only since the last 30 days. And said, you would never lose any of this inside an annuity, playing to that fear, the fear of losing. So you have to understand that when it comes to investing, you have to focus on the big picture. And that's what a good advisor is going to allow you to do.
Yes.
But also understand if you're so loss averse that, you work in U.S. Treasuries, you don't need to buy these expensive products that essentially transfer your wealth from you to the insurance company and to the person who sold it.
And depending on the situation, you may not need to take on additional risk, depending on the situation. And that's something an advisor can help guide you on. I also think it's just a framing issue as well, because, if you have to achieve gain in order to make your plan successful, then that's what we need to focus on, as opposed to fearing loss. Because if you need a certain amount of return for your plan to be, and your goals to be successful, then that's what we need to be focused on, as opposed to fearing loss. I think it's kind of like, anything worth doing is hard. It's kind of the same principle of like, in order for there to be a high return, there has to be some higher amount of risk taken, because that's part of what's being priced in.
Correct. Let's talk about herd mentality, following the crowd versus disciplined investing. I will say that our firm has been really good at avoiding the herd. The first herd that I can really think of that impacted what we were doing here was coming out of the financial crisis. There's so much volatility, and these investment companies are really good about creating products and marketing them to whatever's happening in the moment.
Right.
So they came out with these low vol ETFs, low volatility ETFs. And basically just think of utilities and things of that nature, energy companies that don't move much.
Right.
And so they built up these ETFs and said, hey, get out of the S&P 500. It's too volatile. Buy these low vol ETFs. So many people herded into the low vol strategy. It became more volatile than the S&P 500 itself.
Oh, wow. Yeah.
Right.
That's crazy.
And then the latest one has been, and there's been many more, but I think the biggest one as far as headliners go would be environmental social governance ETFs, ESG. So there's this big mentality, and the herd all started moving toward, oh yeah, ESG is the future. ESG is the future.
Yep.
And I sat here and I'm like, if ESG is the future, then the S&P 500 is going to gravitate to ESG anyway.
Right. So
therefore, why would I pay BlackRock another 15 basis points, 0.15%, which equated to over $52 million in additional revenue off of one fund?
Yep.
When the S&P is going to have the exact same ESG ranking as these other funds.
Yep.
And that's exactly what happened. And that world has fallen apart.
Yeah.
People realized it. And man, all I can think about is like, ESG hasn't performed as well. S&P's performed better. S&P has just as a high ranking as the ESG large cap funds. And so in the end, if you'd follow the herd again, you would have been harmed. You wouldn't have lost all your money, of course.
Yeah.
But you wouldn't have been coming out as ahead as you could have.
Right.
Investing in just the broad index.
Yeah.
I'm trying to think of other herd type things, but I would say as far as like emotional investing goes, it's probably when you hear your friends.
Yeah, I was going to say, like, I was actually talking to somebody a few weeks ago, and he was talking about how he was the only one of his friends during 2008 and 2009 that didn't sell to cash. And they basically talked about, they made this decision like on the golf course. Like he was the only one that was like, yeah, I'm not doing that. Like, that's crazy. And they all did. And, it's like 4 or 5 guys. And I'm just like, that's crazy.
Yep. They never recouped.
But they did it because it's like, oh, that's what my friends are doing. That's probably smart.
I was talking to Sally, and Sally said they moved all their stuff to cash.
Right.
And that's very dangerous.
That's normal for human beings to do kind of what people in your sphere do, right?
Yeah.
So that's something you have to be aware of.
We see it in animals too, like horses. Like a horse by himself is like, oh my gosh, I'm freaking out. I'm by myself right now. And what they do, they run to see to find the next horse and go, okay, you're here, I'm here, we should be okay.
Exactly. That's exactly right.
Let's talk about anchoring.
Yeah. So anchoring is just basically fixating on a past, let's say dollar amount per share that is from the past. And I think the best example of anchoring is if you have maybe some losers in a portfolio and you don't want to sell them and reinvest them in something else, you're anchoring on a specific dollar amount that you want that share to hit or rebound to before you sell it, as opposed to just selling it, liquidating it for a potentially better investment. So I think that's probably the most applicable situation that anchoring comes into. But yeah, essentially, I mean, you see this too with Bitcoin because it has that, dollar amount per Bitcoin. It's like this very like this number everybody tracks. So it's kind of the same thing there.
Before we get back into the episode, have you ever wondered why annuities keep coming up as a recommended investment? While they're often pitched as a way to reduce risk and secure your future, annuities frequently benefit the salesperson more than the investor. Download our free guide, Buyer Beware, Why Do They Keep Trying to Sell You That Annuity, at wiserinvestor.com/guides. Now let's get back to the episode.
Let's talk about hindsight bias. It's funny because this happens all the time, but people go, I knew there's going to be a market crash.
Yeah.
I knew it.
Right.
I'm like, well, what indicators did you use?
Yeah.
Right.
Why are you still invested?
I just sensed it. So you're like a market ninja.
Right.
Right.
Yeah. Yeah. No, I find myself doing this. It's like, I felt like that, but it's not, you didn't actually know. You're just kind of like rationalizing it after the fact, right?
You just sense. Yeah, I met a few people that have this. Oh, we avoided the financial crisis, and then part of me is like, but did you really avoid the financial crisis? When did you know to get back in?
Mm-hmm.
It just, yeah.
I think that was also kind of what we talked about a little bit earlier about like, oh, if I had invested. So there's like the positive and negative aspects of it, right? So it's like, if I had invested in this, I'd be a millionaire, or like if I had, if I had taken my money out of the market, then I would be better off or whatever too. So it's kind of two sides of that coin.
Yeah. It was interesting. Obviously, if you invest at all the lows of the market, you have a tremendous rate of return.
Yes.
But Andrew sent me a chart recently. He showed, he was showing me that if you invested in all the highs versus just random spots in over time, even investing at the highs, you had a 6% higher rate of return than just picking random spots in the market to invest in.
Yep.
So that doesn't mean that you're looking for the highest to invest in. That's not what that data means. That just means that if you think the market's high, it's still a good time to invest, because even if you bought at the all-time high, over time, you still turn out just fine.
Right.
And part of that is because you don't start collecting dividends until you have the investment made.
Yes.
And you're sitting in cash, doesn't pay as much as the dividends. Well, now it would a little more, I guess, but historically it has not. Cash was almost zero.
Yep.
So let's talk about recency bias.
Yeah, again, this is kind of focusing on the headlines and letting that impact your long-term view for something that maybe is short-term in nature. So I think
like tariffs.
That's the big one right now is tariffs. So, while there's definitely, some changes that are being made, does that really impact the long-term value of the S&P 500?
Absolutely not.
What you're saying.
Absolutely not. And William Bernstein has one of my favorite quotes. In the short term, the stock market is a voting machine. In the long term, it's a weighing machine.
Mm-hmm.
That means in the long term, the companies that make money are the ones that stick around. The S&P 500 has been around for a while, has a 7% turnover. So 7% of those companies are having to roll off because of bankruptcy or what have you. But for the most part, those are long-term healthy companies that are there. And you know what? Delta's going to sell you a seat no matter what.
Yeah.
Coke's going to sell you a Coke.
Yep.
No matter what.
And across the world, right?
Yeah, exactly. So yeah, you can't take current market news and try to make long-term plans with that. That's just not a good, that goes back to fear at the very beginning.
Mm-hmm.
It's never a good investment strategy. Anything built off of fear is typically not going to end well for you.
Yeah. And that's something too, like I know we've talked about this on the podcast before, but like if there was a change that we saw maybe that needed to be made for like a long-term time horizon, then we're totally willing to do that. Yeah. It's not just
we make long-term changes all the time.
Exactly.
We added voluntarily, we added Bitcoin and Ethereum to portfolios where clients are okay with that. Because we believe in 10 years that this is a real thing. It's sticking around.
Right.
And that's being confirmed by all the banks that are now starting to hold that at their own banks. Right.
And BlackRock's added it to their target allocation.
And sometime late this year, next year, you'll be able to trade cryptos at Charles Schwab. I mean, who would have thought that would have ever happened?
Yeah.
Anyway, let's move on to confirmation bias.
Yeah. So confirmation bias is just the tendency for people to kind of seek out or interpret information based on their existing beliefs. So it'd be like, seeking news from a source that you're going to agree with, and then interpreting, the news that you hear based on something that you already agree with.
I think this is the biggest thing that our clients right now struggle with is you have very polarized environment with politics right now, right?
Mm-hmm.
And so we get news from sources that might be well educated, but meaning their background, they went to Harvard, they went to Yale, but that news is going to be biased. And on the opposite side, the news can also be biased. And also they use fear in their news to motivate you to either think or do something.
Yeah.
And that's what we struggle. We have so many people with the tariff talks that are on both sides of the aisle right now. And it's a full-time job.
Yeah.
To try to keep all this contained, to say, look, no, we're going to ride through this. We're not done with the year yet, but we're back to where we started.
Yeah.
The year we had that big sell off. Now we're back.
Yeah.
People complain that, everything's so expensive.
Yeah.
And the market went on sale by 18%.
Yeah, it did.
And they still complained. I'm like, it's 18% cheaper
than
it was a year ago. So we're at the price we were a year ago. So this is the time you put more in.
Right.
And it's funny how that works. But the problem with the confirmation bias, so I think this is true of any case, is that there's not enough research done. People don't dig deep enough, and maybe they don't want to. I mean, that's partially why you hire a financial advisor.
Yeah,
but they don't dig deep enough, and so they read a couple articles and they come up with a solution. They draw a line from A to B, and they say this is the 2 data points, and this proves I'm right.
Right,
and then everybody on X and Twitter, or not LinkedIn, became a expert in tariffs.
Yeah, macro economist right. Overnight.
Yeah, and then you had academic people becoming tariff experts, and I love academia. I'm on the board of a great school up in Rome, Georgia, but those who can't teach. And I go back to that and I'm like, okay, give me some real world examples of why this won't work.
Sure.
And you can't give me real world examples.
Yeah.
Because the rest of the world was tariffing us.
Yeah.
Right. So
that's important to understand.
It's like it's working for the rest of the world.
Yeah.
we're just supplying surplus and all that. But anyway, that's not what this is about. But
the point
is that there's a third data point that people aren't considering because they go point A to point B and they assume that's the normal, and that's not the case.
Yeah. I think it's also important to recognize at least that, whatever your affiliations or news source, that negative media does way more numbers wise than positive media. So basically generating negative interactions with a news source or a website or a YouTube channel or something like that, it generates it helps their numbers. So they're kind of incentivized to have these negative engagements, right?
Absolutely.
So that's something to consider as well. Not that what they're saying is necessarily wrong, right? But just something to be aware of.
Yeah. And you can have two people on two different points of view that could be right.
Yeah.
And that's very plausible. And especially now in this environment, tariffs, no tariffs, and are we going to do this with the economy, all the budget cuts, all these things, right? It could end in disastrous fashion. That's very possible. It's also very possible that we had to do something because we can't keep spending the money we're spending.
Right.
And so it's a very open debate because we don't have any outcomes yet. We don't know what all this means for us right now. All we know is corporate profits are still good, which is why the market's back up. And as investors, what else are we concerned about? Right.
Right. Yeah.
I mean,
long-term health of the economy,
long-term health of companies equals long-term health of the economy. So what else could we be concerned about? We just got to be concerned about that our companies are profitable and that people have jobs and wages are going up and all those things are happening. So that's only proof that we have right now. And that's the part that people live in the spectrum. We have one client who tells me constantly, people are losing their jobs. Everyone's losing their jobs. And this is terrible. And the job numbers just came out and they weren't that bad. Actually, they're pretty good.
Yeah.
Market traded up several hundred points on the news. And finally I asked, where are you getting your information from? And his information source was a far leaning website. And I said, yeah, if you work in a government job, you're looking for a job in the private sector right now.
Yeah.
But it's no different than any other time in history.
Yeah.
When auto workers all the auto workers are losing their job, but other jobs are doing just fine.
Right.
When pilots were losing their jobs, but other jobs are just fine.
Yeah.
Sometimes that happens in the economy. Anyway, be careful of confirmation bias. Make sure you're getting your information from the right source. And quite honestly, if it doesn't affect you, turn the TV off.
Yeah.
I don't watch news on a constant basis. I have my stream of blogs and things that I read to do my job well.
Yeah.
But I do not sit there with the TV on all the time.
Yeah. I think it's probably good for your sanity to take a break from it for a while. Yeah. I mean, I can say that for myself, just like, it's watching the news all the time is stressful again. Cause they do make those negative interactions.
I would never read like the AJC or anything like that, but I used to read the Wall Street Journal from cover to cover.
Yeah.
And when I stopped doing that, I was a much happier person.
Yeah, I believe it.
Because and then recently I did, I guess about a year ago, I was on a long flight and I said, I didn't intend to read the whole journal.
Yeah.
I don't really watch the movies that much,
Right.
So I just kept reading. And then when I got to where I was going, I was like, I just felt sad, depressed. And I was like, man, why do I feel so down today? I'm like just really beat down. It's like, oh my gosh, I read the entire Wall Street Journal.
Yeah.
And it was back when the Ukraine war, there's a lot of stuff on the Ukraine war, and it's just really heavy, heavy reading. But anyway, just be careful. So talking about, again, real world examples, investor reactions versus long-term outcomes. We kind of touched on that.
We've kind of touched on this a little bit. I think the main takeaway under this category is just, you can really do damage to your portfolio during these big events, these big market downturns. And, if you try to sell or rebalance during, a steep dip, you could really hurt your portfolio. If you make a decision during one of these emotional times in the market, that's when I mean, that's really when you can damage your financial plan and hurt your goals.
During the COVID sell-off, we had a client that would call once a week, and he would say, what are we supposed to be doing? Like, this is crazy. The market's falling. People are dying. And I was like, look, we have to stick to it. We're going to make some changes in the portfolio, but only to your advantage, not to your detriment.
Right.
And this is when I learned a lot of people don't understand what rebalancing means. A lot of people thought when you rebalance a portfolio, that means you're changing from more aggressive to more conservative.
Right.
And you're not.
Yeah.
Rebalance just means you're keeping the allocation you tended to keep the whole time. It's just that one side of the portfolio has grown or shrunk too much, and we have to reset it. That's right. Reset the portfolio, maybe is a better way of layman's way of saying it than rebalance. But after like the fourth week, I was like, I don't know what else to tell you. And because I had really run out of all my tricks at this point. He wanted to go to cash.
Yeah.
And he says, tell me what you told me last week. So I repeated what I said last week.
Yeah.
And he goes, yeah, that's great. I'm going to call you a week. You're going to tell me that again, and I'm going to be just fine.
Yeah.
And so that's when I learned, it's like, okay, that's my job. That's my job is just keep repeating the message over and over again, the message of portfolio salvation.
Right. Yeah.
And we were going to be just fine. And which is why we tend to get out ahead of this with our emails, which sometimes people don't like my emails. I respond back and say, we need to see action or change in the portfolios. Yeah. And there's less of that. Thank goodness, because we have the podcast, we have YouTube channel, we have videos we do, and we send out. This last tariff thing, 3 emails.
Yeah.
That was it. 3 emails out of hundreds of clients.
Yeah.
So we're getting better of getting the message out, or people just weren't paying attention. I don't know.
Yeah.
But 3 emails wasn't horrible, but we still want to be proactive.
Yeah.
And repeat that same message of buy and hold. In fact, there's another episode you might want to listen to with me and Andrew talking about why would you pay a financial advisor to invest in low cost ETFs?
Yeah.
Because that's a question we get sometimes.
Yep.
Well, this is why. It's the value is not in the portfolio construction. It's in the portfolio management. And sometimes that management is managing the client's expectations as to what happens in a crisis and how you become successful.
Yeah. Sometimes just having that one person between you and the sell button, honestly, that's probably saved a lot of clients a lot of money over time,
Well, yes. Vanguard's Advisor as Alpha study showed that. They said that it added 3% per year to the rate of return by having a financial advisor versus not having a financial advisor.
Yep.
And that's just because clients having missed opportunities. You're playing golf the day that the portfolio needs to get rebalanced. You're playing golf when you should tax loss harvest this one fund to generate a tax credit for you. You're not playing golf and want to go to cash the day you're staring at CNBC and the world's falling apart. And you're like, oh my gosh, I'm losing everything. So, and honestly, financial planning is what really saves that. The advisor certainly helps, but it all starts with the plan and building that going forward.
Yeah.
So costs of emotional decisions. We'll wrap up with this.
Yeah. We've kind of already touched on several of these. So, trying to time the market, obviously we've touched on that a little bit. Missed returns from panic selling. We've already touched on that a little bit. I think you should talk about missing the best 10 to 20 days in the market, because I think you've already touched on that a little bit, but maybe going into a little detail there, because that's huge.
So if you remove the 10 best trading days of the market, you can pretty much cut your return in half. So for example, over the last year, the most of the 10 best days were after the 10 worst days. So you get that rebound. But if you gut out the 10 best days, your rate of return, I don't remember the specific numbers, but let's say the average rate of return was 8% on the S&P. It's going to drop to like 4. If you miss 20 of the best returns, you don't even have a return. It's like flat.
Yeah.
And so that's where it's going to be volatile, but you overcome this. We have what we call a cash bucket system for retirees that allows them to not have to need anything from their portfolio for years.
Yeah.
And if you have that assurance that the market can be crazy, it gives you the ability to turn your TV off, go live your best life, knowing that you've got years worth of reserves built up. And we don't need the stock market today.
Yeah.
And so that's the cost of emotional decisions is when you take that bad day and you liquidate, and then shortly thereafter, do you have a rebound? Like exactly what we're seeing right now.
Yeah.
We've all the people that said, "Oh, Trump's going to run the economy. Trump's going," and he still might. he's got plenty of time left.
Yeah.
But tariffs and all these things that are happening, we are now in positive territory year to date.
Yeah.
So it's not we think that whenever things are happening to us in the moment, that it's going to be like that forever. Now, our older, wiser clients, no pun intended, they know that that's not the case. They know that the kids aren't in diapers forever. They know that the season where you lost your job and you're trying to find a new job and budget's kind of tight, they know that doesn't last. It gets better. They know that tight budget doesn't last. It gets better because your career is going to advance eventually, right? You're going to have the money to do things you want to do, or save what you need to be saving. But for our people that are 40 and younger, I don't know that they know that. Mm-hmm. They think that this is how it's going to be forever.
Yeah.
And that's not the case at all. And so that's where you have to be very careful in your decision making when it comes to the markets. And I think the last thing I'll say is there's no secret sauce. I'd love to sit here and tell you and make this an investment show and only talk about investments and this strategy and that strategy. The reality is that the only strategy that works is picking well-diversified portfolios. So it has a mix of U.S. large cap, foreign, small cap, international, and then a couple of bond funds that match the duration that you need for the risk you want and what's happening in the stock market.
Yep.
Or the Feds and what they're doing, what the interest rates are at. That mix doesn't have to be tinkered with too much. And you just want to keep that cost very low. The average cost of our portfolio is under 0.1%.
Yep. And
then the value of advising comes in with tax loss harvesting and rebalances, and then monitoring and maintaining that long-term plan.
Yeah. And keeping a long-term focus as opposed to,
yes,
quarterly, and during these times of volatility, having that plan in place that shows, 40 years from now, 50 years from now, like that's very important.
Standard & Poor's tracks this. It's called the SPIVA report. I talk about it all the time. It comes out every 6 months for the last 20 years. It is always shown that 96%, or actually it's 98% of fund managers fail to beat the indexes. So if the index is average, you just want to be average because no one else can be average.
Yeah.
And so that's, and then behavior is the second part of that. So it's more in your behavior is what makes you successful as an investor than it is the asset mix.
Yeah.
And if you don't know what you're doing, and you can just close your eyes, the S&P 500, it's kind of hard not to be invest in the S&P 500, just leave it alone.
Right.
But most people can't handle that. They can't handle those 20% down years.
Yeah.
Or in the financial crisis, we had lost 62% in a very short time span.
Yeah.
Those are tough to have. So that's why you want diversification off the S&P when you're building a model. So thank you, William.
Yeah.
Good research on that. So now that we diagnose the problems, right? Next week, I want to talk about the cure. So how do you build discipline, develop your strategy, and take the emotion out of investing? I'm going to do that with Michaela Dowdy next week. So we will look forward to working with her and the solution to all this in part 2 of the podcast on mastering emotional investing. You can listen to other podcasts in the meantime while you're waiting for the episode next week. Episode 154, Investing Through Times of Fear. Episode 277, Tariffs, Trumps, and Turbulence, Making Sense of the Market Mayhem. That's our largest podcast download in 7 days. I think we had 300 downloads in 7 days.
Yeah.
There's a lot of people watching, by the way. Thanks for watching on the YouTube channel. I saw 90,000 downloads over the last 90 days.
That's awesome.
That's so a lot of YouTube listeners. I guess I gotta start doing my hair, so we're gonna be on TV more. Anyway, thanks for listening. Thank you again, William. Congratulations on the CFP.
Thank you. Yeah.
And if you guys want to come here and work with William and Shauna and Michaela or myself or Grace, give us a call. You can reach us at wiserinvestor.com or click on the link in the episode show notes. We'll see you guys again next week.
Thanks for listening to a Wiser Retirement podcast. We hope you enjoyed today's episode. Make sure to subscribe wherever you're listening. That way you don't miss any new episodes. We'd also appreciate if you could leave a rating and review. If you have any questions about anything that was discussed today, head to wiserinvestor.com and reach out. This podcast is strictly for informational purposes only and is not to be considered as investment advice or solicitation to buy or sell any financial products, securities, digital assets, or any other investment vehicles, or a basis to make any financial decisions. Wiser Wealth Management Incorporated is a registered investor advisor with the SEC. The host and/or guests may personally own securities, digital assets, or other investment vehicles mentioned on this podcast. Neither the host nor guests of the show are compensated for their participation, and no referral fees are paid to or received by any host or guest for clients, listeners, or similar interests. Investments involve risk, and unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor, tax professional, insurance professional, and/or legal professional before implementing any strategy discussed herein. Past performance is not indicative of future performance.